Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We got another awesome show today. Our guest is Brad Gerstner, founder and CIO of Altimeter Capital, multi-billion-dollar tech VC-focused investment firm, invests in both public and private markets. He's made venture investments companies, like Snowflake, ByteDance, Zillow. We're going to talk, Brad, about a lot of stuff, the state of tech, investing, AI, and my favorite topic, make sure you stick around to the end, his passion project, Invest America, which I am super stoked on. Brad, welcome to the show.
Hey, it's great to be here, Meb. I'm an avid listener, and it's fun to be able to kick it around with you a little bit today.
Where do we find you today? You in Sand Hill, Silicon Valley? Where are you?
I am. I live here. I've lived here for a long time. In fact, I think I've been coming out to Silicon Valley now, either living here or spending a lot of time here for 25 years. The office is out here. All of our investment professionals are here. I'm right on Sand Hill Road. Share a building with Greylock here. It's a great place to live.
Well, I'm currently, listeners, if you're watching this on YouTube, I am recording from the West End, Milwaukee, which is not too far from where you grew up down the road in Indiana. But I figured we'd start talking about investing. And I was listening to a podcast you did. Can't remember with who it was, but you mentioned a stock name and it gave me PTSD that 20 years later, it's funny how something will color your investing memory. But you mentioned CMGI. And I cut my teeth. I was in college in the late 90s. So my favorite bubbly type of environment. What was your first investment? Do you remember? Was CMGI or something else?
My first investment was probably 7 years earlier. And I bought shares in IBM because Lou Gerstner, same name, no relationship, had come back and was trying to turn it around. And I thought, I like technology. I liked his last name. And so I figured I'd buy a few shares.
I love it. I think mine was E-Trade, but I'm not 100% certain. All right. So fast forward from that time buying IBM to getting a law degree, an MBA, founding companies, starting Altimeter around GFC period. Let's walk forward to today, 2024. What's going on in your world? I know you dabble in both private, public, everything in between. What's the world look like here at the near Q4 2024?
Well, first, I don't dabble in either. I'm all in on both. And so I've been investing professionally for 20 years. But really the red thread that connects, I think, everything I've done as a 4-time founder myself, really starting my career in venture, helping David and Joel launched General Catalyst, becoming co-CEO of their first investment, an online travel company, is really, I'm a student. I'm an anthropologist. I like to study the world of technology, try to make sense out of it, figure out what's being disrupted and who are the disruptors, where the value is being created and where the value is being destroyed. And I suppose if I was a professor, I'd then go teach a class on it. If I was an author, I'd then go write a book on it. But as an investor, you get paid to get up every day to study the most interesting trends and people and technologies in the world. And occasionally you find an asymmetric opportunity, something where you think you understand something in a slightly better way. And you're lucky enough on the venture side to be able to partner with world-class founders and partners and own part of the company and be part of that really long journey like we've been with so many great names. You mentioned a few. And on the public side, again, you get to be an owner, oftentimes a participant there as well in long-term compounders. When you talk about the first stocks in 2005, I was working for a legend in Boston, a guy named Paul Reeder. I was building the technology part of his practice, and I was managing money on the public side, a couple $100 million. And I remember putting almost all my portfolio in Google and Booking.com, Priceline at the time, what became Booking.com, and just had super deep conviction and a very asymmetric view of their ability to long-term compound. And that feeling when you owned one of those things, so that even if it was down 3% a day or 2% a day, you felt no compulsion to sell, you would just buy more. We were early in a super cycle, the internet. It was clear that search was going to be at the top of the toll booth and collecting this fee that they had really wide competitive moats, big advantages. And the average investor doesn't spend the time to understand that, to think about it. And so all the time, it'll panic about something, put something on sale, and give you the opportunity to own these long-term compounders at really terrific prices. At the same time, I had a view, so this is 2005, that being at the top of the internet pyramid, so think of it as search engines or e-commerce engines. In both instances, human beings were looking for information or they were looking for things to buy to improve their lives. So being the top of those funnels, you were extracting a rent. You were the tax collector. And this thing called the internet was going to compound for a really long period of time. And so the tax collectors would grow for a really long period of time. In fact, I teach a class, the old Graham and Dodd securities analysis class, as a guest lecturer at Columbia now for a long time with Chris Begg, which is a lot of fun. And the section I teach is on valuing a disruptor. What did I see and what could you have saw a Google in 2005 or Booking in 2005? And what did the sell side analysts miss? Because markets are supposed to be efficient, but if they're efficient, then why could you buy these companies for a fraction of the price that they trade at today? Right back then, Priceline was trading at $25 a share, split adjusted, it's over $3,000 a share today. We know Google went from 50 billion to 2 trillion. And yet most people would day trade it, they'd make a scalp and that would be it. And they left most of the money on the table. The easy trade was to understand the long-term competitive advantage, the moat, the power of compounding, to own a lot and go to sleep. I once asked Buffett what he could have done to improve his performance. He said, slept more and gone into the office less. He said, when you do all the work as an investor, you come in, you do all this analysis, everything looks like signal. You want to do something. But 95% of the time, you have to do all your homework, you have to study, you have to think, and then do nothing. Because it was that high conviction, qualitative insight that led you into the investment. And so don't let little data points along the way scare you out of the investment. That's certainly been my experience. And that's a hallmark of how we think about the world on both the venture side as well as the public side. And like you said, we started in 2008 in the depths of the financial crisis. And here we are today in 2024, and we've just had some amazing success, but more importantly, been able to partner with incredible people and had a lot of fun along the way.
That brings us up to today. So you guys do the full gamut, not just VC, but public, and then not just long, but also short too. How's the world look like to you today? Is it full of opportunity? Are there a lot of interesting compounders, or are there some landmines out there too? What are you feeling?
Well, I mean, the answer, of course, is yes and yes and yes. We've just been through a pretty treacherous period, experienced things that the markets had not seen in the last 100 years. A global pandemic, interest rates below zero, multiples expand wildly, then multiples collapse in 2022. So really, I thought at the end of 22, and I talked about this broadly, the world was on sale. I happened to write a letter to Meta in November of 22, and the stock was at $90 a share. That was entitled Time to Get Fit. There was tremendous opportunity at that moment in time for the largest tech companies to shake off the COVID largesse. I described it as an open letter to all of us to get back in the office 5 days a week, to get rid of the incredible number of people that were hired during COVID because we thought these insane growth rates were going to last forever. But that's what a pandemic does. It creates all of that volatility, which as an investor, you should be able to take advantage of. Nothing changed about Facebook during this period, but it went from being heralded as one of the great companies of all time to the headlines in November 22 from Wall Street all the way to the internet where Facebook's dead. And Zuckerberg's leadership out of that period was extraordinary. The company went from 87,000 employees to 62,000 employees. Notwithstanding that fact, they more than doubled the size of the business. Earnings compounded much faster than that. And of course, today the stock is 5x higher than where it was at that period of time. But it's hard to hold conviction. Remember, January of 23, Mike Wilson was telling the world we were going to have a hard landing. Everybody was convinced that the world was over. Portfolio exposures were at an all-time low. And actually, at that time, we had all of our chips on the table. We shoved in January of 23 and had one of our best years in history in 2023 because we had seen something in November 22 called ChatGPT. We had been studying AI and investing around AI for a long time. And that was a game changer. We looked at what the 26 sell-side analysts thought NVIDIA was going to do in 2023, and they were laughably wrong. Ended up being wrong by over 70%. At the time, everybody said Uber would never make any money, and Uber was one of our largest positions. The stock was under $30 a share. And so there were opportunities, incredibly asymmetric opportunity at that moment in time. Obviously, the market has moved a tremendous amount since then. Uber's went from under 30 to over 75. NVIDIA's up over 10x. Meta's up over 5x. I mean, these are moves that you usually see over a decade or two, not over a period of 18 months. And so when you look at the opportunity set today, it's different. I don't look at things in our book and say this is going to 2 or 3x over the next 12 to 24 months like I did in the beginning of 2023, but we're constructive. I think this is stock picker's market. When you're at these early phases of disruption, there are winners and losers. And so you have to ask yourself, again, I'm an investor in technology. Who are the winners of this new super cycle? Is compute, as an example, going to take a permanently higher tax on the age of AI than compute did in the age of search? I think the answer to that is yes. And so I think the rake that NVIDIA and the supply chain there is going to take out of the AI opportunity is much bigger than what came before it. So you have to ask and answer those questions for yourself and then build a portfolio accordingly. Today, we're about 70% net long. We have less gross exposure. We're finding short opportunities. At the start of a super cycle or phase shift, whether it's space, whether it's electrification, whether it's AI, you're going to have massive winners and losers. And that's our job. That's what gets us excited. This is a really hard business. And if you're not super passionate, thinking about this all the time, digging and studying and learning and forming opinions, then you have no chance to compete. You're better off just buying an ETF in the S&P 500 or a broader index and going to sleep and just betting on the upside of America, which we'll talk about later in the pod. I also happen to think is an incredibly important thing to do. But actively investing in the market and beating the long-term returns of the market is hard.
Give us a peek what you talked to in this class where you're talking about these compounders and you've lassoed some amazing performers and you've been writing whatever it may be, the name doesn't matter, NVIDIA, Uber, Facebook, et cetera. And you're like, look, I love this company. I love this long term. How do you think about the sell decision? If you look at holding these for these long periods, what's Brad going through his mind when you're talking to this class or you're talking to investors about the actual portfolio management process of either reducing or trimming or outright selling some of these names, which could be held for a really long time?
So when you think about alpha, so alpha, for everybody's benefit, is like, how do I outperform the market? How do I leverage my intelligence or our insights as a team to generate performance that is better than the alternative performance? And for us, one of the key mistakes I see sell-side analysts and other buy-side investors make is, number one, time. Their time horizon is way too short. They're only looking at a period of 12 or 24 months, or in the case of a sell-side analyst, they're trying to get me to buy or sell based on what's going to happen this quarter. First, it's almost impossible to forecast. And second, even if you can forecast that, oftentimes those are opportunities to do the opposite of what is being recommended. So one of the things I say to my team all the time is that thoughtful forecasting, really thinking long and hard and getting your forecast right, not for the next quarter, not for the next 4 quarters, but the next 5 years. That is going to trump precise valuation every day of the week in technology. If you find me a compounder, a winner, somebody who has a moat, and it's going to compound for a long period of time, then you need to have a super high bar trading in and out of that name. And one of the things I love that I teach in that class, and this is a Warren Buffett quote from 1967. Most people think of Buffett from the quantitative school. Like he's sitting there with his HP calculator, calculating the DCF and trying to figure out whether it exceeds his cost of capital and all this stuff. But Buffett said, and this was part of his own evolution. Remember, going from buying cigar butts to buying good companies at fair value. He said, interestingly enough, although I consider myself to be primarily in the quantitative school, the really sensational ideas I've had over the years have been heavily weighted toward the qualitative side, where I had a high probability insight This is what causes the cash register to really ring. So him recognizing that Geico had a distinct advantage in the market, that the automobile insurance market was going to continue to grow for a lot of reasons, that their market share, because of their structural advantage, would go from 1% to 5% to 10% over time, and that the incremental margin on that growth was super high. Once you gain that qualitative conviction, or his conviction around Apple in 2016, when effectively the management team at Apple, which he viewed as an indispensable machine in everybody's pocket, what he always gets scared about around technology is that technologists find a gold mine, but then they take all the gold out of the gold mine and they go make another bet with it and they lose it all on the second bet. He says, pull the gold out of the gold mine and send me my share, buybacks and dividends. And when Apple made a decision that they were going to send upwards of 100% of their free cash flow on an annual basis back to shareholders, I'm sure Buffett said, where do I wire the money? So that's really how I think about it. What's that time arbitrage? What's that qualitative insight that comes from years of hard work on something that allows you to have conviction when the rest of the world doesn't?
Well said. As you kind of look through your portfolio, I've definitely heard you talk about a few themes, and other managers, definitely the topic of the day seems to be AI, and there seems to be some AI themes running not just through your public, but also some of your private investments. Maybe give us an update. What are you feeling about AI today? Is it an area that you're using at Altimeter as well? Just give us an overview. How are you feeling?
So a few key points. Number one, we've been thinking about and investing around the themes of AI for well over a decade. I'm on a board of a company called Cerebras, and Cerebras built a chip that would be better for AI training and inference. This is an observation they had long ago. I was an investor. I led a Series B in a company called Faircast way back in 2005, and they were using early AI techniques to forecast future price movements in airline tickets so that you could basically lock in an airline ticket today without having to worry about future price volatility. Microsoft bought that business, and I remember a conversation I had with them about buying that business. And they said, we're really interested here because the future is about answers, not 10 blue links. And so this idea of getting to answers, having augmented intelligence, and I think it was Bill Gates when asked the question whether or not we'd kind of seen all the innovation we were going to see in 2016, he said, we haven't even started. I happened to be at this dinner when he said this. And somebody said, well, what do you mean we haven't started? He said, we won't even begin until computers go from basic calculators to helping us think. And so the Cambrian moment that came out of these transformer models and the paper Attention is All You Need, the Cambrian moment in November of 22 really did change everything, because it really ushered in this moment where the world was going to move from 10 blue links, a giant card catalog, which was an incredible innovation back in 2000 that would help the world discover anything, to answers. My children don't use Google. Every single night they have ChatGPT open as their co-pilot for their homework. And they're just trained on it. This is just the way that people under the age of 15 or 20 will interact with the world. And if you think about the value of those answers, it's much higher value than 10 blue links. 10 blue links just started me on the journey of finding the answer. This actually is extracting the answer. So I think if you look at the revenue growth of OpenAI that's out there in the public, their revenue growth is dramatically faster from the launch of their public product than either Meta or Google. So people say, well, show me the beef. There's no revenue. People need to pay attention. There is revenue. It's dramatic. NVIDIA is not up 10x because people just started speculating on it and increased the multiple. No, the multiple is actually lower today than it was any time before ChatGPT. It's that they grew earnings 10x. That's why NVIDIA is up. And so we've had a dramatic impact. I think, if anything, they often say these things are overestimated in the short run and underestimated in the long run. And I'm quite confident that the world underestimates today the changes that AI is going to bring over the course of the next 2 to 5 years. But you have to obviously keep your head screwed on straight. You can't just drink the Kool-Aid. You have to make good risk-adjusted bets. We actually have passed on most of the AI investments over the course of the last 2 years for a couple reasons, right? Remember, you mentioned CMGI. Most of your listeners probably don't even remember what it was. This is a company that went from $0 to $2,000 a share and back to zero over a period of 36 months. Its CEO, David Weatherall, was on the cover of Time magazine. He spoke at my Harvard Business School graduation. And a company that was valued as a multiple of future fictional revenues. NVIDIA is not valued at a multiple of future fictional revenues. NVIDIA is valued at 20, 25 times next 12 months earnings. You look at, pick your company, Meta, all of these large companies that are leveraging AI, they're trading between 20 and 30 times. So this is very much not the stuff that bubbles are made of. We've had a lot of post-traumatic stress because of what happened during COVID and in 22, and that's kept a wall of worry in place in the market, which has kept a lot of these bubbles from inflating. But why have we passed on a lot of these early AI bets? Well, remember, back in 97, 98, 99, there was Lycos, AltaVista, InfoSeek, Inktomi, CMGI. Think about all the search companies, Yahoo, AOL. Ask Jeeves. You could have known that the internet was going to be the biggest thing ever. And you also could have been right that search was going to be the biggest thing ever. And you could have bet on any one of those companies and it went to zero. Or you could have waited until Google's IPO and bought the IPO, and you would have captured over 90% of all the value ever created from internet search. So sometimes, like Buffett said, what you need to do is study, prepare the mind, develop conviction, and then wait. And so that's my observation today, that a lot of these early model companies, brilliant technologists, great technology, great backers, but it's not good risk reward because a lot of those technology stacks will end up being worth zero. And the real value is going to go to that company that emerges as the winner in the consumer space, who does offer that experience. I would argue today that ChatGPT is running away with it, but that's a question for people to figure out. Can there be a contender out of the new entrant market among Anthropic and all these other guys to ChatGPT? I would say that game's over, but they're going to have to compete with some incumbents. Meta's at the top of their game. Google has a lot of resources. So you have to build a future forecast based on that with all of the appropriate discount rates and uncertainty. On the enterprise side, I think there's been massive uplift. The growth rates you're seeing out of Azure, out of Google, these simply would not exist today without AI. So a lot of that is people buying and training models with the GPU resources that those companies have. And so we've seen a big uplift, the fastest growth out of any company I've ever seen at OpenAI. So it's clear it offers value. 200 million weekly average visitors are saying about ChatGPT, you're valuable enough to me that I'm going to open this thing every week like my son, and I'm going to use it to help me with whatever task I need to complete. If I look out on my floor here, all my analysts, every single one of them, they have 3 screens in front of them, and one of the screens is open to ChatGPT. That is their co-pilot as investors. So we're leveraging all these tools that will quickly just be ante into the game if you want to compete at the highest levels. So I would say I've lived through 4 super cycles, right? We've lived through internet, lived through mobile, lived through cloud, and now we're at the start of the 4th one, which is AI. I have zero doubt it will be bigger than any one of those and maybe bigger than them combined over the next 2 decades when we go from computers and AIs that really co-pilot our lives to autopilot our lives. They're going to be machines interacting with machines on things like airline maintenance that just do it better than humans. So again, I think sometimes you get accused being here in Silicon Valley that you're drunk at the punch bowl. So you have to keep it sober. You have to measure your risk appropriately, build portfolios appropriately. But it's a privilege to be able to see this up close every day.
How much of this is still a U.S. dominated story? Is that still the case? Or are you seeing pockets of countries or areas where they're starting to make some pretty significant advances, or what's it look like?
Well, I would say that the most important breakthroughs in innovation are almost exclusively today in the United States, but is something we very much should not take for granted. China will have AI that also sits at the forefront. We're doing things to limit their access to frontier quality chips and frontier quality models, but make no mistake, They have all the resources and all the capability to build out frontier level AI. I expect they will. We're also seeing dramatic investment and capabilities emerge in places like the Middle East. So I would say G42 out of Abu Dhabi. The UAE has demonstrated they're incredibly forward-looking when it comes to AI and their intent to be a real global leader in providing intelligence to the world. But the entire Gulf region, the Saudis just announced this week, $50 billion investment in AI data centers. So they are fully capable, and I expect they will be very competitive in the game of delivering intelligence to the world. So this is going to be a global story. This is not going to be a U.S. only story, but I do think that the United States is in pole position today, and we can certainly, at least to our friends around the world, sell these capabilities that will be embedded across every industry on the planet.
So as you think about some of these other themes, I know you mentioned space. You talked about nuclear recently on your podcast with Bill Gurley. What are some other front of mind kind of topics or themes that you're focused on really adjacent or just outside of AI in general?
And remember, AI is going to accelerate a lot of these hard problems. So these are combinatorial. They are not disaggregated. One that I think is front and center of our mind is the multi-trillion-dollar global auto industry. Bill and I on BG2 did a pod on the breakthrough that was Tesla 12.3 full self-driving, where they moved from a deterministic model to a imitation learning model, a closed loop data system where it's constantly improving. So the AI is pulling data from the experience of millions of cars on the road. They're uploading it back to the central computer at Tesla, and they're using that to retrain the model. And so one of the ways they think about risk in these models, when it comes to autonomous driving, is the number of critical engagements per miles driven, and the improvement that Tesla has seen over the course of the last couple months is as much as they had seen in the prior couple of years. So Elon often says the only thing that matters in technology is the rate of change. And because they've now are leveraging the full power of these new models, the rate of change is dramatically accelerated. If you go to San Francisco today, I was there last week with one of my partners, and we walk across the street and there were 4 cars at the various intersection. 3 out of the 4 didn't have a driver in them. Okay, so what does it mean to the world when all of our fleets move not only to electric, but to autonomous? What's it mean for parking garages? What's it mean for congestion? What's it mean for light rail? What's it mean for subways? What's it mean for the OEMs, for Ford, for GM? If Tesla has an embedded competitive advantage, we might not have an oligopoly. Why can't one company win 70 or 80% market share? And then what are you willing to pay when you have a full-time chauffeur? Another one would be this trend around electrification and the consequence on the energy production side of the equation. We did the pod live from Dabble Canyon, which is one of the important nuclear sites in the state of California that's producing 10% of the state's total energy and almost half of the state's clean energy. And you know what happens if we shut down Dabble? We import energy that was produced with dirty coal because we don't have enough energy production in the state of California. And so when you look at the energy baseload power requirements in the United States, they were basically flat for a couple of decades, but now they're going up dramatically. Why are they going up dramatically? Well, we're not putting gas in our cars anymore. We're plugging them into the electric grid, right? And these data centers to power AI are power beasts, super power hungry. So you combine those things, and again, we're just not prepared for it. China, on the other hand, is building 100 nuclear reactors. They're building as much capacity right now as the United States has in total. And you know how many nuclear reactors we're building in the United States? 0. So the regulatory impediment must be overcome in Washington because it's a national security issue. This isn't just a cost of energy to folks in California, although that's going to be a problem as well. But this is a national security issue because if you don't have the power, you can't build the compute. If you don't have the compute, you can't build the AI. If you don't have the AI, you can't use it to be at the forefront of things from defense to your economic growth. And so those are just a sampling of what I think are big issues that is going to create a lot of value creation opportunities.
Well, listeners, we can direct you to Brad's great pod, which you can hear more on that. There's a couple other topics I want to get to, so I want to make sure I save time for both. There's an area that I think you and maybe Michael Malbison are really the only two people that write about, or at least talk about in general, which is thinking about CEOs, and particularly the tech world, and thinking about partnering with these companies as an owner, but also thinking about how they compensate themselves. And this topic is stock-based compensation, which I think for most investors, one of the guys on your team does a lot of great posts, and listeners will link to these in the show notes. But you guys have done a lot of great writing on this topic. Tell me, as someone who's a big investor in many of these companies, how do you think about this topic? And also, how do you talk and engage with the CEOs about best practices on how to think about the subject in general?
Well, you're talking about stock-based compensation, which most people try to turn into an esoteric conversation, but it's actually very simple. When you're paying employees, whether you're paying them in cash or you're paying them in stock, it's coming out of the pocket of shareholders. 100% hard stop. We did a podcast with the legendary CFO of Booking.com, Bob Mylod, who I think has written in the Booking.com annual letters about this subject as eloquent as anyone. But let me just start with two quotes from two of my favorites. Here's Warren Buffett. He says in 2011, he says, "I think the best way to compensate people is with cash. And if you want to give them a bonus for exceptional performance, give them cash. It's simple, it's straightforward, it's clean. I don't believe in using stock options as a form of compensation. I think it's just a way to get around paying out cash. And I think it's a way to sort of camouflage what's really going on." And then, of course, my favorite by Charlie, "I would rather throw a pit viper down my shirt front than hire a compensation consultant." Okay? Now, I would like to say that I believe more in stock-based compensation than Warren Buffett. I do think incentive alignment in early venture capital-backed companies is super important. But unfortunately, as these companies became large public companies, it just substituted for cash. It was no longer about incentive alignment. It was a substitute for cash. And the way we know that is the vesting schedules on these oftentimes are quarterly. So I'll give it to you during the quarter and you can sell it at the end of the quarter. Well, if that's not cash, I don't know what is. And then the real grift is we're paying all this money out. It's a cash replacement. But then we tell you on the quarterly calls, ignore it. We're going to give you adjusted EBITDA and we're going to adjust out this massive cost we have in the business. So listen, Altimeter is goal aligned. I want alignment. I want employees to make a ton of money. I want them to make money if we make money in the upside of the business, but we need to account for it as cash and we need to compare companies accordingly. And so you mentioned Thomas Reiner on my team. One of the things that we've looked at is like, what's the gold standard? Who are the companies that are doing the best job in terms of not only disclosing this information, but also making sure that their stock-based compensation as a percentage of their revenue growth or as a percentage of their earnings growth makes sense. And so we can put a couple of charts in that show the people who are in the gold pack, folks like Apple and folks like Booking.com. And we could show you these companies that are growing less than 10% a year, but have a huge portion, almost 100% of their earnings growth is going back to the employees, which that's not a problem, but it is a problem if you're trying to hide it, right? You just got to be upfront with people and say, we have zero earnings growth once you take into account the dilution that you're suffering as a shareholder. So one of the things that we've tried to do in Silicon Valley is to say this is an essential part of Silicon Valley. It's important, but it's also important to build the muscle and build the culture in the business that respects it as cash, that pays attention to it, that understands that you can't dilute shareholders by 10% a year over a long period of time and then ignore it. Because here's what happens. When you do that, you know what happens? You hire too many people. You pay them too much. The company doesn't get faster. The company gets slower. You get too layered. There are too many vice presidents. There are too many people just going along for the ride. The most important thing here is just trying to build a way to understand best practices, because we sit in all these board meetings and I will tell you the comp committees and the people on these boards have a tough time understanding what is the gold standard. So they bring in a comp consultant and the comp consultant says, you look great. Here's your comparison to your peer group. But guess who your peer group is? 10 other companies making the same crappy decisions. So what you need to do is peer them against the gold standard. Here's what you should aspire to. And it's very simple. Here's what you're getting paid. Here's your total cost of operations, including your stock. And here's what you make. Very simple. But if you listen to these earnings calls and all this adjusted EBITDA mumbo jumbo where they're trying to hide the ball, you would think that this was complicated. It's not complicated. Stock has a cost to the company equivalent to cash. Treat it as such.
Yeah, well said. Again, listeners, we'll direct you to some more reading on this topic, which you know is near and dear to my heart too. But I think certainly spreading a little light and focus on the topic can certainly help as well.
Meb, one thing I just wanted to say on this, that when we did that pod with Bob Mylod and Bill on stock-based comp, I thought nobody would listen to it. I thought this is such a wonky subject. We're not talking about AI or nuclear. It's not nearly as interesting. I think I got more feedback, more questions, more requests to be introduced to Bob Mylod from that pod than any other pod we've done. It turns out everybody cares about this. And the most excellent companies in Silicon Valley, those were the ones most interested. Help us get on the path to the gold standard. What do we need to do in order to do that? And so I actually think that now this is an active conversation on public company calls, on venture-backed company calls. We're moving in the right direction on this. And those who continue to hang out with their head in the sand, they say they're doing a stock buyback to offset dilution as though that's not pure cash. That camp is going to feel increasingly isolated and will get increasingly penalized by the public markets because nobody's asleep at the wheel on this subject anymore.
All right, let's hop to something that I've been excited and pestering you about for I don't know how long, because I'm just super stoked on this idea and the potential for it to really change the composition and look of our country. Give me an overview, but also an origin story when this idea struck you for Invest America.
We've just spent the better part of 30 minutes talking about, in one way or another, the magic of compounding. The only free lunch in investing is to start with a small snowball and find a really long hill and compound that money over a long period of time. So this is the type of conversation that we have around our dinner table. I have two kids. One's a sophomore now and one's a seventh grader. And we often talk about the importance of compounding, but they also know that they're lucky. They know I started an account for them when they were born. They know that's not easy to do. They know a lot of parents don't have the money to start, or they don't have the know-how of what it means to open up a custodial account. And so my sophomore, who at the time was in middle school, I said to him, lots of people don't do this and they miss the first third of that hill, the first third of their life, the first 25 years, they have no compounding. And he said, well, what are we going to do about it? And I love that bias to action. Like, what are we going to do about it? And so I started thinking about that. I started meeting with people on that who had been working on this topic from the left to the right, because there had been a lot of ideas that had percolated over the years. And I came up with the idea that we could simply, at the time somebody gets a Social Security number, start them with an investment account, right? They can open it up on their phone. They can see that they own a little slice of Berkshire Hathaway, of Apple, of United Healthcare, and seed them with $1,000 in the S&P 500. And if we did that, and then we treated it like a 401k from birth. So there are 3.7 million kids born every year. If you start them each with $1,000, that's 3.7 billion. That's less than 0.1% of our federal revenues. This is less than the cost of a single weapon system that we're sending into war zones these days. It's a tiny amount of money to get every child in America into the game. But why do we need to do this? Well, financial literacy is at an all-time low. So only 17% of Americans could correctly answer basic questions about interest rates, inflation, financial risk, mortgages. This wealth gap is getting worse. It's worse than it's ever been. 60% of Americans live paycheck to paycheck, and they're losing faith in democracy and capitalism and free markets. Less than half the people under the age of 40 believe in capitalism anymore. They have an actively negative view of capitalism. That's a huge danger to America. When people start voting policies that attack capitalism, which is the engine that has created the prosperity. But I understand it. Too few people participate in the upside of America. Less than 60% of people own assets that really compound. So increasingly, they think the system's rigged against them, that some elites are the only ones who are getting rich and they're getting left behind. So I think it's imperative. And we have the opportunity to get everybody into the game, make everybody a part owner in the upside of America. Now, I don't want another government program, and I don't think many other people do either. So this is about creating 3.7 million private accounts that your child owns and has title to. They can see it on their phone. They can't trade it. They can't touch it. But think about the inspiration when they're in 5th grade and they see those numbers going up and they start understanding and asking questions about, what does this mean? Is this money really mine? How did it get there? Why does it grow? What does it mean to own a stock? What does it mean to compound? That's the magic. You not only start to attack these problems of the wealth gap, but you get kids to believe, to ask questions that can help enhance their financial literacy. That's where it started. That's what it's all about. We're super excited at the momentum, and we think there's a real chance to get this done and to get this done soon.
So the difference between you and I is you actually get the wheels turning and start to put this to work. This topic, I've written about over the years, and I was tweeting my idea where I was like trying to think, maybe there's some enterprising billionaires that would do this for their state. So I was like, maybe like one of these small states, we tried to do the math. I actually did it on like 5K for some of these states where I was like, it's less than 1%. I think it was 0.5% of the state's budget. But I was like, I wonder if there's a billionaire in Montana or Hawaii or somewhere that could do it just to get the project started. But then you've come along and you said, no, Meb, we're doing this on a much grander scale. Let's do this for everybody. I think the biggest benefit when I see stuff like this is not actually the monetary. That's cool and it's going to actually be impactful. But it's really that it like gets everyone on the same team. It's something to cheer for. I was born in Denver. I'm a Broncos fan. There's not any amount of money you could pay me to be a Raiders fan, but it's a similar sort of concept. Like if you're born and you have no incentive, you have no skin in the game of this country's GDP or what's going on. I mean, Professor Schiller wrote about some of these ideas of GDP bonds and similar topics, but take me from prescription to diagnosis, so implementation, because starting to work with government and policy, my God, that sounds like such a overwhelming task. But walk us forward from idea to what's going on. Has this got a chance? And how painful has this process been?
Maybe it helps that I've started 3 or 4 companies here in Silicon Valley. And on day one, it always seems like the task is Herculean. But like eating a big sandwich, you start with one bite. And so fast forward 2 years, over the last 2 years, we set up a 501c3. I've basically been funding it. Now we have millions of dollars we've raised from great supporters, folks like Michael Dell. In fact, Michael has joined our CEO council along with Mark Benioff and Lisa Su from AMD, Dara Khosrowshahi. These are folks who all say, we not only love this idea, but if you get this passed, we'll contribute to the accounts of the kids of our employees. So the government just starts with a small seed, and then we're going to get all this money coming in, birthday money, bar mitzvah money, 401k like matching contributions from corporates, philanthropic contributions. So I'm really excited. Think of all those states where you have a billionaire, like you mentioned, in the state, and they say, as part of my estate plan, I want to leave $500 million in a drawdown trust that gives $100 matching, $500 matching to every family in my state whose family earns under $100,000. Now they have the financial infrastructure to actually give. And I have no doubt they will, because this is the most giving country on the planet. So we went and started, first me, and then with now our executive director, Matt Lira, in Washington, D.C., really just talking to one by one to congressmen and senators from the left to the right. And here's the amazing thing. There's something that we talk about in Silicon Valley called product market fit. If you can't explain it in a minute, and if somebody's not shaking their head yes, then the idea is probably not good enough. And no matter who we talk to, from the left to the right, people immediately got the idea. $1,000 for every kid in America, invest in the S&P 500. They can't trade it. Starting at age 20, they can take a little out to pay for college. I get it. Say no more. How do we make it happen? And so that type of momentum has built. Where we are today is we have an incredible working group in the Senate that's working on legislative language, includes people on the left and the right. We're not prepared to announce the names just yet. Wait until after the election. And the same in the House of Representatives. And then outside of Washington, like the CEO Council, we have supporters from the left to the right, from former presidents on both sides to the most important policymaking organizations on both sides, financial literacy organizations. You did an incredible pod with Tim Rosetta from NextGen Personal Finance, who's doing great work to pass financial literacy legislation state by state. We're partnering with John Hope Bryant and Operation Hope. He has Financial Literacy for All. He's done amazing work piloting this. And what they all have discovered is this, Meb. If we start this account, we're going to be releasing our own research. If you start this account, everybody who gets it, and this is every child in America, more likely to graduate from high school, more likely to graduate from college, more likely to buy a home, more likely to start a business, less likely to be incarcerated. I mean, the return on this investment will be the greatest return this country has ever seen. And I'm really heartened by the fact that there's a lot of talk, both administrations, and we have support from senior people and both potential candidates for the presidency, but I'm really heartened by the talk. They're talking a lot about financial security of kids, getting them off to a strong start. In fact, both sides are proposing an expansion to the child tax credit. This is the perfect complement to the child tax credit. The child tax credit is just dealing with those essential expenses in that first year or two of your kid's life. This actually creates an account for the financial security and the opportunities for their entire life. And the cost of this is a tiny fraction of the cost of the child tax credit. My goal is this. After the election, we'll know who's running the Senate and the House and who's in the White House. We're going to work with everybody. This is a huge tent. This is about all of America. We're going to have legislation with broad bipartisan support, with language that's agreed on. And hopefully when there's a legislative package that the new president introduces, which I'm sure will include increases to the child tax credit, we would like this included in that piece of legislation. We think it'll be a very big bill. It's going to have to deal with the debt limit. It's going to have to deal with tax expiration. This is going to be a large piece of legislation. And we think there's room for this. This is a tiny expense that, like you said, can unite everybody on Team America. Everybody shares in the compounding upside of America. And think about this. You do this. Now 30 states require financial literacy education. So in the 7th grade, when your teacher says, hey, we're going to talk about compounding or stocks or interest rates. Today, 70% of the kids tune out. They say, my parents don't own anything. I don't own anything. Why am I even learning about this? But instead, the teacher's going to say, open up your phone. Open up your Invest America account. Let's talk about how that $14,000 got there. When you're 20, you're going to have upwards of 50,000. When you're 30, you can have 150,000. And when you're 50, you can have $1 million by just adding $750 a year to that initial $1,000.
By the way, I have a hard time hearing the phrase Team America, not coming up with at least 5 South Park quotes from that show. But do you worry at all? And look, this whole program, I'm so excited about it. And listeners, hopefully you get the same groundswell of support. So as we think about just the specifics and quibbles, do you worry at all that, all right, you got a bunch of kids in the classroom, and if Benioff or somebody is contributing to, say, some of the accounts, because like if we know anything about investing and life and the hedonic treadmill is like, it's fine if I'm making money, but if my neighbor is making more than me, like we're sitting in the class and if like Benioff's donating and one kid's got 14 and one's 5, does that bother you or worry you at all as like thinking about the implementation 10 years from now? Or is that more just like a exhaust from something to worry about later or ideas on those specifics?
I think a couple of things, and I think your nose is in the right area. First, there will be natural limits on additional contributions to the accounts because we know, as a matter of fact, that people who have more money are going to be in a better position to save. At the same time, I think that you may find additional contributions from corporates or from philanthropics are actually means tested. So they may only give to people who are making certain wages. But here's what I'm confident of. Today, a tiny portion of people in that classroom have any prospect of compounding. So is this radically better than what exists today? Yeah, it's radically better than what exists today. So will there be some differences? Well, we have to hammer some things out. I was presenting this to a progressive group, And Bill Clinton happened to be in the room. And somebody said, well, why should your kid get it? Why should your kid get it? We should only give this to a certain group of kids. And Clinton said, that's the problem we keep making. This is a simple opportunity to unite America around a shared economic upside. We can't go dividing ourselves again. It's good enough for one kid, it's good enough for all 3.7 million kids, and the S&P 500 is good enough for everybody else in the markets. It's good enough for this program. And I think we have to approach it with that sense of responsibility. 2026 is the 250th anniversary of America. Here's what I want to see happen. We pass this in 2025 and we start it with the class of 2026. What better gift to every future generation than we took the opportunity on our 250th birthday and we created a dividend for every child who's born in this country. We're not saying we're going to make you a millionaire. We're not saying you're guaranteed success. We're just saying we're going to give everybody a shot with a tiny little amount of seed capital, skin in the game. And I think that's going to unlock more human potential than any program government might do. And we're going to leave it all on the field, Meb.
Might unintentionally start a baby boom in 2026 too.
That's another problem we got to solve. So God bless.
As you move forward and thinking about groundswell of support, I mean, I actually have a hard time. Most ideas I can shoot holes in. I have a hard time coming up with like why any politician would actually be against this, but they're politicians, so who knows? But as this comes closer to 2025, getting involved, is there anything that like the listeners can do? Or is there any way for them to follow along, get updates, and kind of cheer from the sidelines?
There's going to be more than sideline activity to do, but a couple things to start. Go to Google and just Google Invest America. The first thing that's going to come up is investamerica.org. Click on it, go there, sign up for our Twitter handle at InvestAmerica24. And we're going to continuously give updates so you can follow along there. You're going to start hearing more about it after the election. Heading into the new year, when we have legislation that gets hammered out, we're going to run ads, right, to educate. That's why we're raising millions of dollars, just to educate on the power of bringing everybody together behind this idea. And then it's going to be the same old play as it always is, Meb. We're going to want people to write their congressman, call their congresswoman, and make the case that they think this is great for America. We already know through polling that this has overwhelming support on the left and the right. We already know that we're building a bipartisan coalition that people thought was impossible to build, from the far left to the far right, because it's both on the left that they totally get the idea of just the equity and fairness by giving somebody a shot. And on the right, they know the danger capitalism and free markets are in if we don't bring more people into the game. And let me just say, in the age of AI, more people are going to feel left out. When we displace white collar and blue collar jobs with AI, those people will rightfully feel like they're losing, but technology companies and those invest in technology companies keep winning. We need to get them into the game of winning. So if they are displaced, if there is disruption because of these new technologies, they're at least seeing some benefit.
What I most like about this, one of the big criticisms of financial literacy is people are always saying, well, it doesn't work that much and all these various reasons. And part of the struggle, I think, is for a lot of kids, they may not have the tangible account or portfolio to look at. They don't see it. So I did a Twitter poll the other day, and most of my followers are probably professionals, and even they got it wrong, where I said, what do you think the S&P has done since the bottom in 2009? I said, and most people said doubled, tripled, quadrupled, and the answer is it's almost a 10-bagger, which is astonishing, right? Like you think about, that's not that long of a time period. And so, but having the kids have this theoretical concept of money and investing and compounding. But if you start looking at your screen and seeing it, I think that has ripple effects that could be pretty massive.
The great news is there's massive momentum. As Tim said on your show, I think there are now 30 states, including the state of California, that are going to start requiring a semester of financial literacy education in high school. And so we have tremendous momentum around that. Here's the problem. It's like teaching a kid Chinese who thinks they'll never go to China. It's very hard to learn something if you're disconnected from it. Tim said on your show, I appreciated you asking him the question. If they can open up their phone, they have skin in the game. Guess what? Their incentive to learn goes up dramatically. So the efficacy of all this money we're spending on financial literacy education is going to skyrocket. And we're going to have a common platform nationally to use to teach about compounding, because every one of these kids is going to have the same look and feel on their phone. It's going to be Invest America. It's going to be branded with a flag at the top. And they're going to be able to use that as a common language to learn about financial literacy. And so we already have the momentum on the education side. We need to keep it up. We're going to partner with Tim and with John and with many others on that. Now we need to actually create the account that gives them the excitement, the incentive of actually learning.
Awesome. Brad, this has been a whirlwind tour de force. Loved speaking with you about all these topics. We could have done an entire episode, I think, on each one of those. You mentioned where to go, Invest America. If people want to kind of follow along with y'all's writing on Substack or Altimeter, where are the best places to find what's going on with y'all there?
Every single one of our analysts was on Altimeter and open sourcing their research. And like I said, Invest America 24 on Twitter and investamerica.org. You can just Google it to stay up to speed. And then I appreciate the shout out for BG2, where I'm Bill Gurley, the legendary venture capital investor, and just all around really smart investor who comes out of that Santa Fe Institute kind of mindset. I debate all things investing.
Awesome. Brad, it's been a pleasure. Thanks so much for joining us today.
Thanks for having me.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.